The cost of living crisis in the UK is raging. We have inflation, which is rampant. We have interest rates, which are on the rise. We have impending recession. We have uncertainty over property prices. In this video, we're going to unpick all of this, and I'm going to lay out for you the strategy that you should focus on to not only hedge against all this uncertainty, but come out prospering. Hi there, my name is Ranjan Bhattacharya. I've been investing and developing properties for the last 30 years. You may have seen me on the hit Sky TV show Property Elevator, or attended one of our central London networking events, the Baker Street Property Meet. Okay, I've got a lot to talk about today. I've split it up into 6 sections. I'm first of all going to talk about inflation and my views on the outlook for that and what it actually means for property investors. Then we're going to look at interest rates and the cost of money. Then we're going to look at the whole big R word, the recession. Will it happen? Will it not happen? And what that will mean. And of course, property prices, are they going to go up, down, sideways? What exactly will all of this mean for property prices and why? Then I want to have a look at the rental market. What's going to happen to rental prices across the UK in the coming years? And finally, I'm going to piece all of these trends together and give you the strategy, the change of course and direction that you need to take right now in order to make sure that you not only survive the years ahead, but you come out thriving. Now, before we get started, let me tell you about the Baker Street Property Meet. It is the UK's largest property investors networking meeting, which takes place in central London. I host that meeting. It's typically on the last Wednesday of every month. You can find out about this month's meeting at the website below, bakerstreetpropertymeet.com. We have 300 property investors attend each month. Tickets sell out very fast, so book your place now. Let's start by looking at inflation. It is rampant, and that is the main driver of this cost of living crisis. Now, real inflation that you and I are actually experiencing is in double digits. It's probably around 12% for most people. And that's sort of levels of inflation most people haven't experienced since the 1970s. Now, the main driver of this inflation spike is, of course, energy and fuel. Now, a lot of the media and politicians are telling you that this is all because of the war in Ukraine. But the fact of the matter is, energy prices were spiking up before Russia invaded Ukraine. Now, the reason for that is simply because of all the money printing that has gone on during the COVID crisis. And I've mentioned this in previous videos on money printing. I've mentioned stats like the fact that 80% of all the US dollars ever printed in entire history have been printed in the last 2 years. Now, what all that means is if you make more money into the supply, then of course it's going to take more of that money to buy real things which are in finite supply. And that's exactly what's happened, and the main reason why things like commodities such as oil and energy and food and also building materials and supplies have gone up in recent years. Now, the thing with inflation is I'm not entirely convinced that anyone has put in a plan to actually bring it down. Now, the way inflation has been controlled in the past is by raising interest rates. When interest rates are raised to a level above inflation, it usually has the effect of dampening the whole thing down. Now, in the 1990s, of course, when interest rates went to nearly 15%, inflation was about just under 10%. And that was the measure or the pain that was required to bring down inflation. Now, I don't see the appetite for raising interest rates to the level required to bring down inflation. So my prediction is that inflation is likely to continue to be at high levels for the next few years. Now, quite frankly, several years of inflation is going to be bad news for most people. If you've got savings, they get eroded. If you've got pension investments, the value of those pensions will go down. If you are relying on salaried income, that is unlikely to keep pace with inflation. So you've got to have in place a strategy to hedge against inflation, survive it, and also come out on top. And at the end of this video, I'll explain exactly how you can do that. We'll get back to the video in just a moment. What is the most exciting opportunity in property right now? And that is repurposing defunct commercial buildings to residential use. Now, most people don't really know where to start, what to look for, and how to exploit these opportunities. And that's why I've prepared 90 minutes of free training for you to get you started on this wonderful journey. You can register for this free training at property-workshop.com. Join me on that free training, and I'll leave you to enjoy the rest of the video. So what's going to happen to interest rates? Well, interest rates will rise a little bit, but I think they're basically playing lip service to the inflation beast. Interest rates are currently at 1% right now. If you're borrowing money on a buy-to-let mortgage in a limited company and you fix your rates for 5 years, you can get borrowing at just under 3.5%. So let's think about what that means for 1 second. If it cost me £4 to buy a house, and I am pretty much putting £1 in and I'm borrowing £3 from the bank. If that £3 is at a fixed rate of interest at 3.5% for 5 years, and the real rate of inflation is 12%, then the cost of that money is cheap. Bank of England base rate is currently 1%. The prediction at the moment is that that's going to rise over time to around 3%. Now, that is still much, much cheaper. It's going to be a third of the rate of what inflation is running at. Now, quite frankly, in past inflationary cycles, we've never had this. To tackle inflation, what they've always done is put up interest rates to above the inflation rate, and that usually dampens it down. There's no appetite to do that this time round, which means that the cost of borrowing money is going to be remarkably cheap. Now, interest rates in the UK pretty much follow and shadow what happens in the US. And in the US, the sentiment definitely is that interest rates will rise. Now, I always look for indicators in the real world to point in the direction of these predictions that I make. And this is one of the indicators that I look at here. Now, this is Vanguard Mortgage Securities. Now, it's an ETF in America. Now, what this is basically is a collection of mortgage books that you can basically invest in by investing in this ETF. Now, if you look at the graph of the value of this ETF, it has really tanked, particularly in this month. Now, that is because the market is expecting the Fed to increase their rates quite dramatically in the coming months. The key point here is that interest rates in the UK will go up. What will they go up to in this cycle? I don't expect them to go up beyond 3%. But remember, as long as whatever the level of interest rate is, the real rate of inflation is much higher, then basically if you're buying leveraged assets, you're borrowing money, you're fixing your interest rates for as long as possible, and you're producing positive cash flow, you'll be quids in. Now, what about recession? There's a lot of talk about, are we in one or is one coming? So a definition of a recession is when you have 2 successive quarters of a fall in GDP. We've just had one fall in GDP that's been recorded. We could go into recession, or we could just bounce on the top of a technical recession. But the thing is, whether we are technically in recession or not, it's going to feel like one. And this is also the view of the CBI, the Confederation of British Industry, who put out a report a couple of days ago where they said that the average UK household disposable income will fall 2.2% this year, which is the largest decline since records began in the 1950s. And that fact in itself will mean that whatever the technical definition of a recession, it will certainly feel like one. Economic growth in the UK is going to be poor. Actually, it's predicted to be the lowest, bar Russia, of all the major G7 countries. You know, the government's going to tell you it's all because of COVID and all of that, but the reason why the UK is ranking right at the bottom there also has a little to do with the Brexit fallout. So, rampant inflation, rising interest rates, impending recession always has an impact on property prices. And here, the picture is a little bit confused. Now, we've had 10% pretty much annual house price growth for a little while now, and that obviously can't go on forever. Now here's the thing, in the UK we've always had this link between average house prices and average earnings, and there are very, very few times where the average house price goes beyond 8 times average earnings. And there are good reasons for that, because when you get to a situation where the average house is priced at above 8 times the average earnings, lenders start to get very, very uncomfortable with giving loans out to that level, and they require higher deposits, and people don't have those higher deposits, so the market or prices tend to flatline a little bit. And they flatline until wages increase a little bit, which gives room for house prices to then rise again. So what we have is this situation where you've got the inflationary trend, which is rampant. Sooner or later, house prices will catch up to that inflationary uplift. So if we keep on getting 10% inflation each and every year, sooner or later, property prices will match that. But in the short term, property prices will lag behind that inflationary trajectory simply because wages are not keeping up. And specifically in the UK, we have this classic problem where we need 340,000 new homes each and every year. We're barely building 200,000 of them. The government wanted to address this with major planning reforms, but these have been massively watered down in the Queen's speech, so they ain't going to happen, leaving permitted development as the best surefire way of adding new homes to supply in a quick manner. And also, we've got rising cost of building materials, we've also got new, tougher building regulations that are coming in, and we've got ever increasing cost of complying to the green agenda and in making new build homes extra efficient. All these factors are increasing the costs of building new dwellings and adding them to the market. So all of this will inevitably mean that in the UK, house prices will be relatively resilient. Now, Savills have recently updated their forecast for the next 5 years, which kind of broadly agree with what I'm saying. They're expecting that 2022 will see the last of the sort of rampant year-on-year price increases. We may experience a small fall next year, but modest, pretty much flatline growth over the next few years. Now, do remember, a lot of this data is on house prices, and generically they mean property prices. I think there's obviously houses and there's leasehold flats. And I think I've done a video on the advantages and disadvantages of buying flats or houses. But I think the gulf between houses and flats is going to open up in the next few years. What's going to happen, of course, is that houses will be preferable for investors over flats. And the reason for that is because of the service charge. What we're going to see is, I believe, an above inflation increase in the service charges that are going to be applicable to flats. And that will mean the net profit that you'll make from renting out flats as opposed to houses will be less. Now, if you're liking this video, smash the like button. Also, let me know your comments, whether you agree or disagree, in the comments below. Also, subscribe and hit the bell icon so you can receive updates when we put out new content. Now, this sort of flatlining of house price growth directly affects your property investing strategy and your property investing game. Stay tuned. At the end of the video, I'll explain exactly the strategy you need to go for going forward. Now, let's look at the outlook for rents. Now, rents in the UK have gone up, and they've gone up for one main reason. Now, the main reason for this is that the bulk of buy-to-let properties in the UK have been owned by people that just had 1 or 2 properties. And those people who are not doing it as a business have basically sold off. Now, I've got this report here which says that since 2019, the number of rental homes available in the UK has halved. So landlords are selling off for a variety of reasons, partly because of the Section 24 tax on mortgage payments. We've got some videos up there relating to that. It's partly due to HMO regulations, EPC regulations, and also the removal of Section 21s and the like, which basically means that if you're doing it in an amateur way with just 1 or 2 properties, it ain't going to make sense. Buy-to-let now is a business where it's go big or go home. You really need a portfolio of at least 6 properties to make the investment in the infrastructure for running that portfolio worthwhile. And that's why we're seeing smaller time landlords sell off in such big numbers. So this has had a dramatic effect on rents. Rents are going up, but I think there is a maximum. And we are seeing the limits of that maximum because there's only a maximum share of wallet that rental payments can take up from average salaries. We're pretty much at that level now. So I see that leveling off. So what strategy are you going to follow over the next few years to actually not just survive this turmoil, but also thrive? Now, if you're just on a wage, it ain't going to keep up with inflation. If you're relying on a pension, which is linked to the stock market, then the value of that pension is going to fall. If you've got cash in the bank, the value of that cash is going to erode over the next few years due to inflation. What do you do with it? The stock market is expecting recession. Many stocks are tanking for that reason. The crypto market has gone into absolute freefall. The overprinting of currencies around the world means that diversification currency-wise is not as good an option as it was a few years ago. So what are you going to do? Well, the answer that I've found in times like these is property. And here's why. Property is an asset class that can be purchased in a leveraged way. The money that you borrow from the bank, you fix that interest rate for as long as possible. And at the moment, and for the foreseeable future, I see that interest rate being far less than inflation. What that means is the value of whatever amount you borrow from the bank will gradually shrink over time. But sooner or later, the value of the property that you'll end up buying will increase. And it will increase in line with the inflationary rises that we'll have. Obviously, those property price rises are not going to go anywhere in the next few years, but it will catch up. If you're investing in property today, the best thing to do is to completely forget about capital appreciation. Pretend it will never happen. So if you're pretending capital appreciation is out the picture, then why would you buy an investment property? You'd buy an investment property for cash flow. When I started investing in property in the early 1990s, it was just after a major crash in the late 1980s. And people were saying, the experts were saying, that we'd never have capital appreciation again. And there was only one reason I bought property for. I just assumed that there would never be capital appreciation again, and I bought property for cash flow alone. And it's pure and simple. You buy a property, you borrow what you can, you fix the rate of repayment on that debt for as long as possible. You repay interest only. Now, if after doing that you're producing positive cash flow, then you have certainty. Now, the great thing about recessions and times like this is that although the sales market might be uncertain, the rental market booms. People want to stay in place. A lot of people, particularly the owner-occupier market, do not like buying houses when there's times of uncertainty. They prefer to stay put. The owner-occupier market tends to act as a herd. You know, when the herd are galloping onto the market, they kind of go and buy property then. If there's uncertainty, they stay on the sidelines. And when people stay on the sidelines, that means the rental market booms. So my advice would be to purchase leveraged assets, fix the interest rates for long as possible in order to buy property to rent out. Because cash flow is king. If you're producing surplus rental income month on month, that allows you to deal with the cost of living crisis and the short-term uncertainties. And in the long term, capital appreciation will come back at some point. But I think it's silly to predict when that will be. In terms of types of property, focus on freeholds. Focus on freeholds rather than leasehold flats and things. Service charges is going to eat up your profitability. But the thing is, smaller flats actually make better returns in terms of rental. So invest in multi-unit freeholds, or better still, buy freehold properties and convert them into smaller flats. The best way to do that subdivision right now is using permitted development rights, because you don't have to go through complicated planning permissions. You can do so under permitted development rights. Now, when a recession happens, it also has an effect on the commercial property market. It basically means that there's an oversupply of commercial properties. Also, right now, we have permitted development rights, which allow you to repurpose defunct commercial properties into residential use without going through convoluted planning permission. So if you take these properties, convert them into flats, put them onto the rental market, finance them on fixed rate money, you'd be quids in. I think HMOs are going to be a bit challenging right now, because when you do a house in multiple occupation, you usually offer a fixed rent for a room, which includes an all-you-can-eat buffet on your energy costs. Now, of course, we all know electricity, gas prices are going through the roof, and coupled with the fact that a lot of companies are encouraging working from home, what that means is companies are saving on office costs, and people are sitting in HMO properties all day working on their laptops. So basically the cost of providing heat, light, power, internet has shifted from the employer to the landlord. Now, that's all very well on single lets where the tenants pay all the bills, but on HMOs, basically the cost of providing an all-inclusive rent has increased for the landlord because of the increasing energy costs and the fact that a lot of tenants are at home during the day. And there's increasing legislation, licensing laws and all of that, which is decreasing the net profitability of HMO properties. I've mentioned this on previous videos. I think the better way to achieve the high cash flow of HMOs is to actually do a CMO, which is a commercial building in multiple occupation. This is when you take a commercial building or a mixed-use building and you use permitted development rules to convert it into multiple flats. You get the same cash flow benefits that you'd previously get from HMOs, but because you don't have costs such as energy costs and all of that, because those are all the tenants' responsibilities, your net profitability is much higher. Now, if this is new to you or you want to learn more about this, I run a series of webinars where I go through the whole concept and how you can take advantage of this fantastic opportunity. You just register on the link below and join me on one of those free sessions. That's it for this video. Tell me what you think in the comments below. Also like and subscribe so that you receive new content from us, and see you guys in the next video. High streets across the land are changing forever. Basically, there's an oversupply of retail premises. Shops are closing down, more are going to close down in the future. The government know this, and that's why they're introducing a light touch planning system which allows small developers to easily repurpose these buildings to residential use under a light touch planning regime called permitted development. Now, this is going to be the biggest revolution and the biggest change and the biggest opportunity for property investors that I've ever seen. And this is all coming into effect on 1st of August. So you need to know what's happening and what properties to look for to take advantage of these opportunities so that you can get in there and take that first mover advantage. I've got a 90-minute free masterclass to get you ready for August the 1st. Make sure you join me, click the link below. Whether you're a beginner or expert, we'll get you started.